we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Well, if I may, you mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week.
We're getting some rate cuts today,
and also
y'all.
we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up.
This is what makes stocks
for this year actually moved up.
Everything from stocks to gold, crypto, housing, everything you can think about. This is what makes it go up.
And really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side
so
of that,
they're talking about how much money they made because of cutting rates the last time they did. So that's basically what's going on right now. So they're about to do the same thing, and he just said how much money they made the last time they cut rates. So basically, them cutting rates made them a whole lot of money
affect mortgage rates
just from doing that.
And that has been
that's what you need for anything from stocks to gold to anything like crypto, houses, anything. Even if you go in a grocery store, you're gonna see stuff get a little bit more expensive just because of this rate cut. So that's what's about to happen. Even in the grocery store, stuff gonna be more expensive.
To matter a lot for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing.
I had to get on here because it was live, y'all. So I'm on here.
There's a deeper problem here.
With
there's
the live.
A cyclical problem that the Fed
I had to get on here. I'm about to get my hair done.
Pretty much nationwide.
It's tired right now.
Shortage. Or a lot of places
get
in the
my
country
shit
just
done.
don't
You
have
feel me?
enough enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther.
I'm about to cut it off. Rate cuts.
So that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Right.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet than pause the unwinding?
Okay. That's what we got going on, y'all. All right.
I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above
I'm about to go ahead and cut this off so y'all see what's going on. Y'all understand what rate cuts is. I was trying to get y'all to understand it. So hopefully you understand a little bit more. Now you're about to see a whole lot of stuff happen in the world. Like basically the prices of goods are going to go up now, housing and everything. But if you own stocks or crypto or something like that, you're going to be in a good position. So there you go. That's what the whole point of everything right there. Gold, stocks, crypto, housing, that's all about to go up. You feel me? So that's what you're supposed to be in right now. You ain't supposed to be in nothing else. So get into stocks, get into gold, get into crypto, get into something that's going to go up in value because of these rate cuts. You feel me? A house, whatever it is. But if you stay in dollars, all that's going to happen to your dollars is going to go down in value because everything in the grocery store is going to go up in value. Everything, like I said, gas and housing, everything will go up. So you get into something that's going to save you from inflation. It's called a hedge against inflation. So that's what you're trying to do, get a hedge against inflation, y'all. So that's what's up. That's what you're trying to do. So
stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that,
All right.
considering
we out of here.
Somehow
Peace.
Incorporate that in as something in a different way.